This AgVision program is made possible through the generous support of Syngenta Seeds NK brand. The results you need, the freedom to choose. And by Farms.com. Ag news, market prices, ag careers, and farm real estate. You'll find it all at Farms.com.
Now let's put those top managers to work. Today the team tackles this comment from David Cole. Tomorrow's farm managers will use working capital and debt to grow their businesses. They won't rely simply on expansion to ensure financial health so that when the business cycle goes south, they don't go south with it. So round the top manager team table we go, beginning with Larry Martin at the George Morse Center.
I think that's a very sensible, conclusion to draw. The worst mistake that some people make, I think, is to get into a major capital expansion and you do it all with debt instead of using your working capital at the same time, and you set yourself up for a huge amount of risk. In other words, I see it a lot in the hog industry that when you have a period of profitability, you're getting to the point where your debt to equity is relatively low, so you go and invest in another barn or 2 more barns or 3 more barns or something like that. You build up your debt, and you do this just at the time when you're going to have a low price in the low part of the price cycle. So now you've expanded and made yourself much more risky. And I think what David's trying to get at with that is do it gently, do it conservatively, and don't set yourself up for a whole bunch of risk in one part of your balance sheet or the other. And I totally agree with it.
Well, I would only agree in part. Growth is a strategy that needs to be managed. And the key is how fast you can grow your equity, not necessarily just how fast you grow your working capital or how much faster you can access debt to fund the expansion. There's been some excellent research done by financial experts on how fast people can grow. Every year when I teach at the TPAP program, I ask a number of questions of the participants before they arrive, and they develop this data in a 5-year trend analysis. And one of those questions is, what is your average rate of growth over the last 5 to 10 years? 95% of those participants have never been asked that question, nor have they actually calculated the data. And just by asking the question, it causes people to reflect. What is my strategy for growth? How fast do I need to grow? Is it 5% a year, 7, 10? What are the reasons for growth? And a fundamental issue in this whole thing is that you cannot grow your business faster than what you can accumulate equity capital. If you try to grow faster than you can build equity, the only way you could do that is if you have substantially improved your production process, which is more efficient than it was in the past, or something else has changed in your business. But many times people get in serious financial trouble because they don't think about the prerequisites to growth. They either grow too slow or they grow too fast. When you grow too slow, basically you depreciate yourself out of business and you've got too far behind the competition to survive. When you grow too fast, your debt-asset ratios start getting out of whack. Your liquidity starts deteriorating because you're trying to service debt that you can't service, and then you just get into a spot where you're no longer viable financially.
The typical strategy for growing a business is expansion in land size or herd size. And what he's referring to is the farmers of the future, and it's what we found in our study of top farmers, is that to grow the business, you don't necessarily have to have an increase in herd size or an increase in land. And what top farmers are finding is they're using their equity and their debt to put more depth into the existing business. And so we're seeing in some cases it's more intensification, in some cases it's more diverse markets, but there's ways and means of securing more stability in the current operation through strategic investments in whether it's marketing or supply chains or other contractual arrangements, so that when things do go south, you're not over leveraged.